Good morning friends, welcome to our channel The Master Strikes. In this video we'll discuss how economy works and we'll discuss about what is inflation and deflation. And in the later part of the video we'll discuss some basic terminology used in the stock market. So let's start. Market. The economy consists of different markets: the wheat market, the car market, the stock market, the oil market, the gold market and many more. Economy consists of all these different things. So if you add up the total spending and the total quantity sold in all of these different markets, you have everything to know to understand the economy. People, businesses, banks, and governments all are engaged in some of the other transactions, exchanging money and credit for goods and services. I hope it's clear. The biggest buyer and the seller are the government, which consists of two important parts: the central government and the central bank. The central government collects taxes and spends money, and the central bank, which is different from all these other buyers and the sellers in the economy, because it controls the amount of credit flow in the economy. It does it by influencing interest rates and prints more money. For this reason, central bank is an important player in the flow of credit. Credit. Just pay attention to this topic. Credit is the most important part of the economy and probably the least understood. It is the most important part because it is the biggest and the most volatile part. And just like buyers and sellers are needed for a transaction, so the lenders and the borrowers. Lender wants to make more money and borrower wants to borrow more money and buy something they can afford, like a house or a car or starting a new business. Credit can help both the lenders and the borrowers. Borrowers promise to pay the money in the future, the principal plus the interest rate. And when the interest rates are higher, there is less borrowing because it's expensive. And when interest rates are low, borrowing becomes cheaper because it's less expensive. Settled. So why is credit so important? Because when a borrower receives credit, he can increase his spending. And remember, spending drives the economy. This is because one person's spending is another person's income. Every rupees you spend, someone earns. So think, when you spend more, someone earns more. And when someone earns more, his income rises. Lender wants to lend more money because with net production of goods, prices rises. And when prices rises, we call it inflation. Mehengai, what we say. The central bank does not want too much of inflation because it causes problem. So what it does, it increases the interest rate. And after interest rate rises, there are fewer people to borrow money. And the cost of already taken loan rises, what we call debt. Example, payment of your credit card, payment of your car loan goes up because people borrow less, and with higher debt repayment, they have less money to spend. As it is explained before, as one person's spending is another person's income. So when people spend less, prices go down, what we call deflation. Let's start with some basic terminology of stock market. We'll start with CMP. CMP, the current market price, is the price on which the stock trades. It is a live market price. Second is the open. The open price or the opening price is the price, the first price on which a stock trades on an exchange. Then comes the close price. The close price is the last price on which the stock trades on a particular day. The LTP, the last traded price. The last traded price is which when the buyer and the seller prices matches and a transaction is done. What we call the last traded price, LTP. The bid price, the fifth one is the bid price. The bid price is the price on which the buyer wants to buy the stock. Then comes the ask price. The ask price is the price on which the seller wants to sell his stock. Intraday is like a transaction done on a particular day and square off on the particular day itself is called intraday. मीन्स इन हिंदी आज ही लिया और आज ही बेचा, उसको हम लोग बोलेंगे इंट्राडे। एंड डिलीवरी इज आज लिया और कभी फ्यूचर में बेचा हम लोग ने, sold on some future date, that is called delivery. Hope this much is clear. Point is bulls and bears. Bulls is when market is on rise, we call it bulls, and when market is on downfall, we call it bears. जब नीचे आता है तो bears है, ऊपर जाता है तो bulls. Then comes square off. Square off is closing of your transaction. When you buy and you sell, you close the deal. That is called square off. In simple words, the 11th point is exchanges. We have NSE, BSE, the MCX and the NCDX. The national NSE is the National Stock Exchange of India. The BSE, formerly known as the Bombay Stock Exchange, it comprises of 30 most largest active traded stocks on BSE. It's a benchmark index. Then comes the MCX and the NCDX. The MCX is the multi-commodity exchange, which basically deals more in the gold, silver and the metal sectors, while NCDX, the National Commodities and Derivative Exchange, is more inclined towards the agriculture sector. Then comes the portfolio. The 12th point is the portfolio. Portfolio is a collection of financial instruments like stock, bonds, ETF, mutual funds. Many times when we talk, your portfolio compromises of how many stocks or bonds. It is a mixture of financial instrument. A portfolio consists of a mixture of a financial instrument. Then comes the lower circuit and the upper circuit. The exchange sets up a price band at which a stock can be traded at a particular day. The highest price a stock can reach on a particular day is the upper circuit, and the lowest price a stock can trade at a particular day is the lower circuit. Circuits are fixed as per exchanges and differs from stock to stock. It might be 5%, 10%, 15% or 20% for that particular day. The 15 point, again it is index in the Sensex. Index compromises of the 50, Nifty 50. The Sensex compromises of the 30 stocks. Hope this much is clear. There are many more terminologies of stock market. We'll cover it in some later video. Thanks for joining. If you have liked the video, please like and subscribe. Thank you. Thank you once again.